To go to our next segment, though, which is Wrap the Week. And when we wrap the week, what I like to do is start with the Mindful Investor Live chart list. This is a chart list that I look at. This is part of my weekly routine. But before we get there, sorry, I did want to mention a poll. We have polls going on our channel all the time. So anytime we bring up the StockCharts TV page, you're going to see a poll. I'd encourage you to participate. It's one of the things that allows us to gather some feedback from you, but also gather some insights about what you're seeing and what you're hearing. Helps us to think about these shows. And one of the questions we asked you was about real estate. Is it a good or bad time to invest in real estate? 40% of you said good time, 26% said bad, 35% neutral. It'd be interesting to see how those answers evolved over time as the market sort of sold off, because it probably seems like more and more of a better opportunity just to diversify away from sort of risk-on equities. But interesting that 40% of you say it's a good time. Real estate is one of those asset classes that historically has been relatively inaccessible to individual investors. It's become much, much more so. So with ETFs like the IYR, with the XLRE, the S&P sector SPDR, there are plenty of ways to get exposure to REIT and real estate based things. We talked with David Auerbach from REITbeat not too long ago at the Money Show in Orlando. Had some great discussions about real estate. We'll hope to have him back on the channel soon. Let's get to our weekly wrap, sort of building on that defensive theme and going to the Mindful Investor Live chart list. If you don't have this, just go to my page, go to the Mindful Investor blog. To get there, go to articles, click on Mindful Investor, and you'll see a link at the very top to copy this chart list to your own account. So please feel free to do that. And again, I hope this is not the last thing that you look at, but hopefully it gives you a starting point to build your own routine. This is part of the weekly routine I like to do. And I like to start with a long-term weekly chart of the S&P. This is a market trend model that I started following years ago, and it's doing the difference between the 21 and 34-week exponential moving averages. This does not give a lot of signals. It's going to stay positive most of the time. The only times in the last 5 years it's turned negative was here toward the end in the fourth quarter of 2018 and here in mid-2015. Those are the last two times it's turned negative. It is still positive because one big down week is not going to trigger it because it's based on longer term moving averages. It's tried to minimize the noise, and we're in a pretty bullish pattern because it's been in a long uptrend. So from that trend following perspective, it's going to take a lot more time for it to roll over and trigger. But overall, you know, it still remained positive. What is more concerning for me on this chart is the weekly MACD or the weekly PPO. Similar, very, very similar signals and same signals, just a little different calculation. And what this has done is this week, now locking in the weekly close has given a bearish signal. This is more the tactical read on the S&P from what I found. So it turned negative here in the second quarter of 2019 when we had a pullback there. Turned negative again going into end of July into August, sort of identifying this short-term corrective pattern, and now once again has triggered. What's interesting is you look at how elevated it had been. It looks a lot like the beginning of 2018. 2018, after that initial big down move, became more of a time correction than a price correction. Like that was it. We didn't go lower than that for a while and ended up making new highs. I'm not sure what's going to happen here. That is one way that it can play out. The other thing is a deeper price correction, which is what we saw in the fourth quarter of 2018. So it's too early to say which one of those it would be, but it is telling you we're in a corrective mode according to that weekly MACD, weekly PPO. This next chart is the breadth by cap tiers. We refer to this often, and I color code this over the weekend, and as a quick foreshadowing, I will most likely be putting all these in the red. We had the large cap breadth in green because it had been making higher highs. Now it's gone to a new swing low, and the sell-off this week has certainly, indicated the distribution, and that's what that cumulative advanced decline line is now recognizing. We had seen that earlier, though, with a bearish divergence with the small cap. So small cap breadth had already beginning worse and started breaking down earlier this week before large cap. So all four of these, I would argue, now in more of a negative territory to a new swing low. So until you see some sort of bottoming sign, a higher low of some sort, this is going to be a negative read from breadth. So we're going to switch that going into next week. Here we're looking at breadth in the form of new highs and new lows. And again, we have a lot of new lows. We had very few, especially on the S&P. But if you look this week, every day, every session, an increasing number of S&P names making a new low. This is not updated yet through today. We've got to sort of finish the closing process and see where things play out. But as of yesterday, 86 out of 500 stocks had been at a new low. It's about 17% or so. of the S&P names yesterday. As of today, I think that number is going to increase a lot. What you have to remember with any one of these charts, I just want to show you this very quickly, is it's very easy to just get caught up in the last 1 year and think, okay, this is an extreme reading. And if your window is only 1 year, I think you're going to get a very skewed perception about what is happening this week. Remember, this week is unusual if you look at just the last year or even the last couple years. You have to go much, much further back. So I would encourage you when you're looking at charts now is start to look at longer term charts and see where these levels relate to other previous sell-offs. Because now what you want to think about is how does this sell-off relate to the end of 2018? That's the most recent really painful market move that we had. How does that relate back to the beginning of 2018? You can see already we've well eclipsed the new lows. Most stocks were actually still not making new lows there. All of a sudden here we're seeing a much more of a downturn. Many stocks making new 52-week lows. This is starting to look a little more like the beginning of 2016 or mid-2015, the beginning of that cyclical bear pattern where we broke to a new market low, real capitulation. We rallied back into resistance before making a new low, and I think a lot of people will be seeing it does now relate back to that 2015 period. I think this is one where you'll be able to make that decision. So we'll have to see how many new lows we were able to print today, but I would be looking back to the left on a 5-year plus chart to sort of see how this relates to some of the longer term bottoming patterns. Other things to highlight, this is another one I want to just focus on very quickly. This is the percent of S&P stocks above their 50-day or above their 200-day. We talked about that 50% level being a really important level because any short-term pullbacks have sort of ended there. So if you look at the beginning of 2018 in January, we bottomed out around 55%. Here we bottomed out around 50 a number of times. When we finally broke below it in October, that was telling you it was going to be more of a deeper decline. We've already now broken below that 50% level, which again, from my read, puts this more within the context of some of the deeper corrections. It's not sort of the garden variety pullback to support. I think we're in a different realm there. What's very interesting is only 7% of the S&P remaining above its 50-day moving average. All the sectors now back below there. So, again, in the short term, it's putting us back into those real extreme blowout lows that we've seen historically. Boy, I feel like a wrap of the week could be an entire hour, if not an entire day's worth of digestion. So we just got through a couple of those charts right now in our wrap of the week segment. I would encourage you to download this Mindful Investor Live chart list. Start where we just did, but go through the entire list and try to get a little deeper at it. I would also point out now is a really good time to look at the scooter rankings. And just to finish up our segment here, look at the scooter reports, look at the large cap stocks, and look at the top rated names. This is a percentile rating. So anything in the 90+ percentile is holding up okay relative to all the other stocks out there in the large cap universe. So look there for some of the stocks that are actually holding up okay, trying to find support as opposed to the ones that are really getting blown out to new lows.